My next guest has some thoughts on how this market volatility could affect investors. Christian Thwaites is the president and chief executive of Sentinel Investments, managing about $23 billion. That's a lot of responsibility. Christian, good to have you with us on Bloomberg.
Thank you.
So what do you make of the release of all of this oil? It's not that much, 60 million barrels. I mean, we're talking about something that's going to happen, over the next 2 months? And I think that between the time that the announcement was made early this morning and now, we've already used about more than 60 billion barrels, so a million barrels, rather.
It sounds like a lot, but the U.S. consumes about 18 million barrels a day, and the world consumes about 80. So it's about less than a day's production. So I think really what it's trying to do is fill the gap voided by Libya. And in the OPEC meeting a couple of weeks ago, which really sort of ended in disarray, there was no agreement on how to fill that plug. So I think it's a tactical move, but I think really it's a kind of a fiscal stimulus disguised as a price move. And there may be some short-term
What do you mean
help.
by that? Meaning that the governments around the world are basically saying, look, whatever we can do to make it better for consumers, we want to keep inflation low. We don't want it at $100 a barrel. So watch out. We can come out with these moves out of nowhere. This is only the third time this has happened.
Yeah. Well, I think clearly in the sort of first quarter of the year, inflation and inflation expectations are very much hurt by the rise in gasoline prices. So I think this will take some of the sting out of that. And as much as that destroyed some demand, this might replenish it. So I don't think it's going to help inflation in the short term, might help consumer confidence in the long term. My concern is that it's such a small number on such a big market that the signaling may not last for very long. But at least I think it's an attempt to sort of re-stimulate the economy when really most of the other traditional tools are just simply not working.
Do you think it's also an attempt to kind of get into coordination with the Saudis? Because they've been talking about pumping more oil. The Iranians, they don't want to pump more oil. They want the price to move higher because that's really where they earn all their money.
Yes, I mean, Iran and Venezuela and that kind of, formed their own side in the last OPEC meeting. And I think Saudi made it very clear that they would like to pump down another 1.5 million a day. And I think this helps that. The puzzling thing is that the oil price is already moving in that direction anyway. So it kind of did a one-day jump, and it'll be interesting to see if it sustains.
Tell me about unemployment. We got the initial jobless claims report today, 429,000. It was not positive. People were expecting lower claims. This has been a consistent pattern now.
It has, and I'm in the camp that a lot of it was affected by the three big headwinds that we had earlier this year: Japan, weather, and inflation numbers, all kind of rolling off. We saw it in the ISM numbers and the production numbers. But I am quite bullish about employment in the medium term. I don't think we're going to see 200,000-300,000 on non-farm payrolls. But all of the recent activity indexes from the Philly Fed and the Empire and today's Chicago talked about increasing employment in the months ahead. So I don't think we're going to be looking at too bad news for too much longer.
All right. So what happens to interest rates? I mean, if you take a look at loaning your money to the government, you're not going to get very much. I think the 10-year is at what, 0.3? I mean, 2.9, right?
I know, and that's kind of caught us a little bit by surprise. We could see it heading to 3. I think a lot of that is technical because a lot of the cleanup of balance sheet goes up between.
Because we're heading into the end of the quarter, right? A lot of people, they want to get rid of all those trades, book whatever profits they have, and move on.
Get all the risk assets off the books and book the treasuries. But so I don't think those are going to last for too much longer. I see the correction on the upside more like to 3.1, 3.2. But there is certainly an element of interest rate repression, suppression, call it what you want, going on in order to keep interest rates low and anchored low, and that was reinforced again in the FOMC meeting. My
guest is Christian Thwaites of Sentinel Investments, responsible for about $23 billion. Christian, Mario Draghi coming in as the new head of the European Central Bank to take over for Jean-Claude Trichet. There was a news report earlier today that the French were not balking at Mario Draghi, but telling the European Central Bank that the Italians cannot have 2 votes on the board of the European Central Bank. Do you think that there's any dissension going on? I mean, if they were not all linked, joined at the hip over Greece, do you think that all these European Union countries are in lockstep about policy? Because interest rates going up in Europe, that doesn't make sense.
It doesn't make sense, and I think the ECB has kind of slightly taken that thread off the table recently as some of the growth has toned down, and then the CPI numbers are also a little bit lower. But I think the French are just sort of flexing their muscles to make sure that Draghi was a sort of a bit of a foregone conclusion, but not necessarily the first choice, and there is some historical baggage of having an Italian central banker in a strong position like that. So I think they're just more like firing a shot over the bows to say you've got to really sort of toe the line on the kind of ECB total Europe front.
Yeah, but it's nice Italian baggage. It's nice leather, right? I mean, he's going to do very well.
Nice leather, but it's an economy which is just about to teeter into some serious problems.
You think that Italy is also going to be facing big problems?
Well, it doesn't have the big headline numbers like the very large GNP to debt ratios and deficit, but a lot of its core businesses have been hollowed out over the last 4 or 5 years, and its political leadership has been disastrous for 10 years. So I think although Italy is sort of in the Portugal, Ireland, Greece, Spain category broadly, it's not as immediate threat on default, but it's certainly not one of the healthier economies around.
You sound cautious on Europe. I mean, I've read recently that you think that you should avoid European banks.
Must avoid European banks.
Must avoid European banks. All right, well done.
I mean, the second-tier banks outside of the SIFI, the significantly important financial institutions, sort of like the top 25, they're in serious problems, I think, if there's any kind of reprofiling. And I know that's a sort of euphemistic for rescheduling of the debt of Greece. They're going to be in some serious problems. There's probably about a 70 billion euro capital hole amongst the second-tier banks. And amongst
70 billion capital hole about second-tier banks.
Which they the equity might be able to absorb some of that, but they'll be coming back to the capital markets. And I think generally in the large European banks, it's the top-line growth. It's the same problems in the U.S., but it's a bit more magnified than it is in the U.S. because the top-line growth is just not there, and the capital is pretty thin.
All right, so avoid European banks, but do the Greeks get any kind of restructuring? I mean, did they get some kind of voluntary rollover so that the debts could be paid? Because right now you're in a situation where you're borrowing money just to pay the interest on money that's already been borrowed.
No, it's a disastrous situation. I think the only way for Greece to really survive is some sort of maturity extension or some sort of reprieve on its interest rates. And we have a model for this. Iceland has done exactly this. They came to the UK and the Netherlands, and they said, we will pay under the following circumstances dependent on GNP growth. And so, that's been a little bit off the radar screen because I don't think people want to follow that model. But I think something like that will eventually come to be the resolution, just because you can't have an economy that's contracting and its GNP debt ratio still exploding, and people on the streets, which we've seen almost non-stop for 3 weeks now.
All right, so having said all this, as someone that's responsible for $23 billion of client assets, what are people to do with their money? What do you think is appropriate right now? You've taken a look at some measures of almost stock market sentiment. For example, margin debt, borrowing money to invest in stocks.
That's a little high right now. Margin debt is about $318 billion. It's about 2% of stock market capitalization, which is what it was in July of 2008. And of course, we went into a pretty ugly fall and spring at that time. So some of that's got to come off. And I think right now we're seeing a lot of trading mentality. But that makes it a good time, I think, to kind of stock up on the good companies that we've talked about before, the dividends, the rising dividends, the good balance sheets, good free cash flow, which are pretty, looking pretty attractive after a 10-15% correction.
Always a pleasure. Thank you very much. Christian Thwaites coming to us from Sentinel Investments.